Welcome all to our YouTube channel. It's Victoria from TRADEPRO Academy, and in today's video what I'm going to be talking about is something that is very, very relevant in today's market situation. So we are coming into the end of the summer, and so far markets have been choppy, they've been slow, they've been grindy, and they have been fairly difficult to trade. So what I'm going to be talking about is actually how to trade choppy and slow markets and understand going forward when these conditions can appear. So trading these markets isn't something very easy to do, and it really gets into traders' heads on a psychological perspective and honestly pushes a lot of people to abandon systems and strategies that they've grown over the years and perfected over the years based on just slow, irritable movement. So I'm going to be breaking that down and how to actually navigate these markets with, again, the same tools, nothing changes, but I'm going to show you a few specific caveats that you can use. So if you guys are excited about this video, hit that like button, hit that subscribe button, and I'll see you guys right after this intro to break it down further. Now, first and foremost, we have to define what a slow and choppy market is before we can learn how to actually trade it with confidence regardless of the movement or regardless of the levels. So a slow and choppy market realistically is a classic summer market where volume has been drained out of the market. Typically, if we take the reference point of the S&P 500 futures before the market opened coming into 929, there is usually about 200,000-300,000 contracts that have been traded overnight. If you see anything under that, right, 180, 150, even 200, pushing it on the extreme side, 1,000 contracts traded before the market opens at like 929, you have the potential to see a slower market. Now, in summer conditions, a lot of traders are away from the desk. A lot of investors, institutional money is away from the desk just going on holiday. So we got the juniors sitting behind there, and you just got enough to make the market move around. The thing is, with slow and choppy markets, you lack the volume, you lack the volatility, and what happens is there's more erratic price movements and there's slower grinds to either side. Now, you don't necessarily know the extent of the market move until the day is over. So you can have a trend day if you look at it maybe at 4 p.m. today Eastern time, and you can say, wow, what a trend day, that was great. But if you were there trading in real time, it might have been extremely choppy, just only to have a few bursts of movement where you could have caught, you might have probably not caught because you were expecting no movement at all, and all of a sudden large market orders come into the market. It could be a range market as well. It could just be a sideways trend where you have just sideways chop. Now, to understand these fully and experience them fully, right, you're going to have to be looking at the S&P 500 futures. Is what we're going to be doing and using as an example today to identify the slowness and the choppiness of the markets and how to navigate them, because they are realistically very frustrating, especially for newer traders that are used to maybe a little more volatility, and they're forcing trades, they're pushing trades, over trading in conditions that don't meet any real trade criteria. So how do we go about this? One of the ways to really realize what's going on in the market and understand if the market's slowy or choppy is taking a large step back. So if we take a large step back in the market, what I mean by this is you want to take an overall picture of what had happened over the course of the last few days, maybe last few weeks, and understand the minute movement. We get really trapped when markets are barely moving, they're slow and choppy, and we're looking at these very minute rotations and minute movement that really gets us in our heads and are focusing on the wrong things. So even if we take a look at what we got here on the screen, this is from August 9th, you've seen that there's barely any price movement in these rotations. These things rotate about like 5 points at a time. And this whole area that I'm showing you on the screen right now is a 40-minute interval. So 40 minutes go by and price barely does anything. A lot of traders looking at this are thinking, well, this is probably typical summer movement, low volatility, low volume. But the thing is, if we can take a step back, even if this happens, right, we can identify tradable zones at areas of actual opportunity. One of the best ways to do this is taking that step back, understanding where you stand in the whole story of the market. Understand where you stand in a distribution sense, right? Are you within a distribution where we're in balance, or are you at an extreme that's actually tradable? identify where those key levels are, where those tradable zones are, and also where order flow has been traded in the past that actually made markets move to a certain degree. So if we take a step back, we could be even looking at the last week, the last 2 weeks, last month, and see what the story of the market is. So for example, here I'll show you on the screen, if we start dividing this into distributions, we can see that there is a lot of chop and slop in the middle, but if we just identify those extremes, we will probably have to be really patient and wait for those areas, but those become tradable areas that allow for actual decent moves in the market. So if you want to take a look at the bigger picture, right, a lot of people use multi-time frame analysis, which means that they might be looking at maybe an hourly or a 4-hour chart to identify their day trades. Those are fairly arbitrary figures because time is somewhat more of an arbitrary sense when we're talking about day trading futures. What I want to be focused on is actually identifying where prices sit in relation to their balances, and that's where we can talk about volume profiles and distribution theory. So if I take a volume profile, for example, and I look at the past few weeks or the past month's volume profile, I can get a fairly solid image of what the price has been doing over the past month, regardless of the speed and the volume and the volatility of the general market movement. If I understand what these volume profiles are doing, I can identify where the distributions are, meaning where price balance is and where imbalance may be. And I want to be focused on trading the actual extremes of that price balance rather than focusing on trying to identify where the next move might be if we're sitting in an area of balance. Keep in mind that price balances based on distribution and volume profiles, when we're in those large bellies, what happens is there's very choppy movement because no new information enters the market. When there's low volume, low volatility, this is typically the case, and it amplifies the market actually staying in that range and that distribution, getting very choppy and sloppy rather than actually making stronger moves. Now, on the other hand, if we can identify where that is, we can, one, avoid it, two, identify where those extremes are to actually have tradable opportunities. I just wanted to show you guys quickly here in the middle of this video what I've been talking about overall when we talk about these distributions areas, understanding where prior trades had happened, right? Introducing some of the order flow. You can see we can mark up this chart with some key distributions here. And the point being is that, yeah, it looks like there's a lot of market movement realistically that is going down, that there's a lot of movement in this market. There's a lot of areas that could be traded. But when you actually sit there and trade this, there's just choppier movement, there's slower movement. So the emphasis that I'm trying to make is we can split the volume profile up into key distributions and key ledges. And the thought process is we want to trade only these areas, right? Because they appear about 10, 15 points apart, and those are the only strong areas. You also have to understand how distribution theory works, because if you're entering a distribution from below there and we start opening and closing within these larger distributions, like you can see like this, there is the anticipation that we do continue the upside. So a lot of these dips right into the low bound of the distribution is probably going to get bought up. Then you have like key barriers that are like intraday ledges that if we can open above them, which we're trying to here, and we can actually hold a bid above them, what happens is you're going to get those key areas to actually enter into trades to get that press back to the upside, right? Targeting some of these upper regions. So if we take a look at 44.15, that was an area that was traded on the prior day a lot, right? Rejected multiple times. We got what we call stuck longs at that area, right? And anything above is going to actually get these guys unstuck and hold a bid. So if we look at today was a 60-point move off of that day, right? Not every day is going to be slow and grindy, but it was grind to the upside. You have net delta 2,700, meaning that there's 2,700 more buyers and sellers that actually bid above this price at the 15 exactly, which was the prior day's huge stuck long area. So if you remember this order flow, if you can get above this area, you can buy into it for that extension to the upside, which is what had happened on today's trading day. So even if we go to yesterday's trading day, you can see how this area held out extremely well, right? Getting trapped and pushing down, pushing down. This is actually the bottom of that ledge that we were talking about over here, where if we can move above it, we expect it to hold for that next extension, right? So we're only trading a handful of levels here, regardless of how slow this is, because this is about an hour movement. This right here is about 2 hours of movement. Very, very just dry and just dries your eyes up. And you can see today, once we started rallying back above the 10 area, which again, another key ledge, and what's here, the 15-16, where we actually made the move back up from the prior day's stuck traders, and we get this massive extension to the upside, right? And I'm not saying that, okay, you're looking back on this, it's like a great trend day, right? But the thing is, these moves, right? This move right here, you can see it starts around like 10:30, and it actually starts breaking at 12:30. This is 2 hours of movement, right? 2 hours of just torture. But if you understand where the key levels are and you understand how this DOM actually works in terms of bulls versus bears, you'll understand that a lot of these areas were dip buying opportunities. All right, let's take a look here. I'll show you quickly before we get back to this video. But you can see here, based on orders, market orders that are coming in, you have a plethora of large buy deltas. You have large buy deltas here holding out price, meaning that bids are strong, right? A lot coming in here holding, meaning that bids are strong. And you can look at these very shallow rotations to actually get that upside and be fairly calm about this, because you're expecting that these guys should hold out if they keep buying and buying and buying, and no sellers whatsoever are coming in. So keep in mind, right, you have to zero in on where these key areas are. Like I said, there's a lot of info on our website and also on YouTube on how to find these key ledges and distributions and understand distribution theory a little more to give you a better understanding of what directionality is and how to trade just very key and concise levels in a choppy, slow market. Take this area, for example, mid 40, giant ledge right before we get into this 60 region, this low 60 region right here. So if we can move past it, right, on a big bid, this area right here, we enter into this little block of distribution, meaning we're expecting to hold it as support to continue that leg higher, targeting these like mid to low 60s. Right. So that's just a very quick, easy example there. And there's a lot more to it and a lot more that you can learn about this, and keep patient, only trade those key sizable levels. Let's go back to this video. One of the main tools that I use is a 50-day volume profile on Sierra chart. You guys can see it up. We'll put it on the screen. And we can divide this into large distributions and play only the extremes of the distributions. Distribution theory goes a little further than that in terms of understanding where price is coming from, how it accepts distribution, what the order flow around it is, using volume and market profiles on a day-to-day basis. But generally speaking, if we look at the right-hand side profile, it's a 50-day profile that splits up distributions very well. Even just by understanding where we sit in terms of these large distributions and where price is coming from, we can have expectations of where price might stall out, hold, trade, right? And that's going to be at those key extremes of the distribution. So that's something that we do want to understand when we're talking about volume profile. In terms of volume profile, we have an extreme amount of resources that are available on our website and also here on YouTube that you can go check out, and as well as distribution theory. But one of the key metrics here to avoid choppy sloppiness is avoid trading in large volume distributions that have huge clusters, and rather look to trade the extremes where we can identify that there are strong-handed market participants that could be entering into the price, right? So there's several examples of this occurring where we can identify multiple distributions that we'll paste on the screen. And what we're looking for is ledges. Where are the key ledges for the actual volume profile to hold out for a real move rather than chopping and slopping for the next 50 minutes. Another tool that you have to have in your arsenal when trading these slow, choppy markets and avoiding just getting squeezed and beat up is going to be patience and adaptability. You have to be very patient in these trades, in these moves, because you have to understand that these moves are not going to happen very consistently throughout the day. You might get 1 to 2 trades a day, and over trading, trying to press things, trying to make things work is just not going to happen, right? As retail traders, we have just a few contracts on the line here, while institutional money actually makes the big moves. So there's no way you're going to press a move. You're not going to force a move realistically. So you have to understand patience and waiting for the zone that you think is an actually tradable area. So for instance, if we're using volume profiles, where is the key volume profile ledge that I would see as a potential tradable area? Now, adaptability and understanding that slow and choppy markets, right, they happen throughout the majority of the summer, meaning that you don't necessarily want to think that it's going to be over one day and back the next. Understand what a slow and choppy market looks like in the first 20-30 minutes of the trading day, where you might be trading in a range, or you might be trading in the initial balance after the first hour of the trading session based on a market profile. Understand key metrics like volume. How much volume traded in the first 20 minutes? How much volume traded right before the open? If it's under 300,000, 200,000 on the S&P 100 futures, well, you're most likely going to have one of those days that can get choppy, even though it trends or it doesn't trend. Now, one of the other things that you have to understand is that in these slower market environments, I would decrease risk, right? Decreasing risk means decreasing size and potentially changing your outlook for target expectations. Right. Generally, I look for 5 to 6 points on moves, but in summer markets, choppier conditions, I might have to readjust to maybe looking for 4 points and maybe taking a little less risk and taking less size on positions so I don't hurt myself if I get chopped up realistically. And it's very possible these summer market conditions are more difficult to trade, and generally speaking, traders don't do as well in these market settings. So it is a more difficult time period when the volume and volatility is just extracted out of the market. So understand that you might want to be trading less of size, right, and less consistently, which will result in less profits, but it results in more consistency and more stability in your trading. Another thing is we have to understand that slow and choppy markets are most likely going to be compressive, meaning that there is going to be range trading in this market. A compressive market is a market that has no new information entering the price action, which means that you're going to have that sideways chop that usually stays within a distribution block, which usually stays within a tighter range, whether it's 30, 40, even 50 points. The point being is understand if you're in that balance or outside of that balance and try to trade the extremes based on the range on that day. That doesn't mean that you can't have trend days within the larger range, but you have to understand where you stand in the grand scheme of things, which brings us back to point number one. Take a step back, especially in summer markets. Take a step back when you're talking or you're looking at the market and it's getting choppier, it's getting slower, less volatility, less volume. Always look at where you find yourself over the past few weeks, how you got there, and where you trade based on a distribution extreme or just a distribution in general. So if this helped, please drop a like and a subscribe to our YouTube channel. It was Victorio from TRADEPRO Academy, and we've been trading these choppy markets all summer long. I'm not gonna lie to you, some days are difficult, some days are hard, but we try to limit the risk as much as possible, and a lot of the days are good. It's just a matter of focusing on the patience and being able to be resilient enough to wait for your levels to trade. And understand you don't have to force trades, you don't have to trade. If there's a few trades a day, right, or even if there is none, that's totally normal because you're looking to take those 8+ setups rather than looking for anything that moves, right? You're gonna be profitable when you wait and you're patient rather than when you're jumping in the market and trying to trade multiple times over. Now everyone makes those mistakes and it's totally normal, so that's why we're making these videos. And even I am guilty of making such mistakes on some occasions. So I hope you guys enjoyed this video, and I'll see you guys in our next one.